Welcome to the Deep Dive, where we analyze the most crucial earnings calls and really try to cut through the market noise.
And today, we're definitely cutting through some noise. We're unpacking Sphere Entertainment Companies, that's SPE, their second quarter 2025 results. A print that, well, it caused some serious volatility.
Yeah, whipsawing is probably a good word for it. If you just glanced at the pre-market, you saw this huge pop based on one massive number.
Right, a real jaw dropper on the bottom line. So our mission today is pretty clear. Dissect that headline figure, understand what really drove it, look at the actual strong operational performance in Vegas.
Which is definitely there.
Definitely. And maybe most importantly, analyze management's vision for that global network, especially this new small-scale Sphere idea they detailed.
Okay, let's jump right into that financial picture because, like you said, the numbers seem to tell two completely different stories at first glance. That initial enthusiasm, that big stock jump, driven entirely by GAAP diluted earnings per share.
That was the shockwave, yeah. $3.39 per share. I mean, just think about that. Consensus was actually expecting a loss. Somewhere between, $1.44 and $1.57 a share loss.
So we're talking a beat of roughly $5 a share. $5.
It's a massive beat, absolutely spectacular on paper.
And this is the critical, but the top line, the actual revenue, it's slightly underwhelmed, came in at $282.7 million.
Right. Consensus was looking for maybe $286 to $288 million. So a slight miss there, though it was still up 3% year over year. Not terrible, but...
But it creates that immediate disconnect, right? How do you miss on revenue but blow away earnings estimates by that much? It definitely makes you look closer.
It absolutely does. Now, to be fair, there were some genuine operational bright spots. Adjusted operating income AOI that surged to $61.5 million. That's a really strong 140% year-over-year jump.
Okay, that's significant.
Yeah, and their overall operating loss improved, too, by about $21 million compared to last year. So operationally, things were moving in the right direction.
So if the operations were better, but maybe not that much better, and revenue slightly missed, how on earth did they get that $5 EPS beat? You, the listener, really need to grasp this because it's why that initial rally just kind of fizzled out.
Yeah, it really came down to non-operating factors. Specifically, it was the effects of some pretty significant debt actions related to the MSG Networks segment.
Ah, the other part of the business.
Exactly. They successfully restructured that credit facility back in June, and doing so resulted in a pretty sizable gain on the extinguishment of debt, those non-operating gains. That's the entire explanation for that massive gap between the revenue miss and the EPS beat.
Okay, so we basically have to look past that $5 headline beat because it's essentially an accounting game. A one-time thing from sorting out the balance sheet, not money they made selling more tickets or popcorn.
That's the perfect way to put it. It was a necessary financial maneuver, cleaning up the balance sheet, and it created this huge but temporary paper profit.
Right. Okay, let's put the balance sheet aside for a moment then and talk about the actual Sphere venue in Vegas, because the operations there did seem genuinely strong. Sphere segment revenue was $175.6 million. That's up 16% year over year. Solid growth.
Yeah, and that growth was really fueled by better utilization. Management talked about getting more corporate events in there. Plus, they had 9 additional residency shows compared to the year-ago quarter. They're filling the building more often.
That's key.
Absolutely. And the content seems to be working. Postcard from Earth, their original show, it's now crossed 4 million total tickets sold. That's a pretty decent run.
And they're watching costs, too, right? They mentioned SG&A expenses were down year over year.
They did, down about $5.7 million. So they're trying to find efficiencies even as they ramp up the number of events. Good discipline there.
Okay, now let's swing back to MSG Networks. Because you said its financial engineering was key to that big EPS number. Revenue there was actually down.
It was, down 12% year over year to $107.1 million. And the main culprit, no surprise really, is subscriber decline, down about 13%.
Yeah, that's the ongoing story with regional sports networks, isn't it? Cord cutting continues.
It does. Though they did get some offset from higher affiliation rates, so the net revenue drop wasn't quite as bad as the sub-decline. But the crucial piece for the quarter's results was that debt restructuring and related agreements.
Okay, explain that a bit more. What exactly did they do?
Well, they amended their media rights agreements and essentially got retroactive announcements, basically reductions in the fees they owe for the current 2024-25 NBA and NHL seasons.
Retroactive adjustments. So like a refund on fees they were expecting to pay?
Kind of. It effectively lowered their expected costs for this season going forward, and that accounting change flowed through immediately. It drove down their direct operating expenses for the segment.
Ah, okay. So lower expenses mean higher operating income for MSG Networks.
Exactly. It significantly boosted the AOI for that segment, landing it at $36.5 million. It was a really important move to stabilize that part of the business and address some financing concerns that had popped up earlier in the year.
Got it. A necessary fix, it sounds like. Okay, let's pivot to the future then. CEO Dolan seemed pretty focused on the content strategy and this whole global expansion plan.
Yeah, definitely. The immediate focus seems to be proving they can launch new content successfully and, importantly, charge more for it. The next big original experience is The Wizard of Oz at Sphere.
Right, Dorothy, an immersive glory.
Something like that. And they've already sold over 127,000 tickets before it even opens. They're aiming for 200,000 pre-opening.
And the pricing strategy there is interesting. They're charging more for Wizard of Oz than for Postcard from Earth, aren't they?
They are. It shows confidence. They're essentially saying, we think this new IP is a premium experience worth maybe what you'd pay for another major Vegas show. And they're testing that price elasticity.
It'll be fascinating to see if that holds. And they mentioned tech, AI specifically.
Yes, they highlighted using AI through a partnership with Google as being pretty critical for hitting the immersion levels they wanted for Wizard of Oz. But interestingly, the next piece of major content, something called From the Edge, expected in 2026, they said will rely less on AI and more on live capture.
So they're already iterating on how they create this stuff.
Seems like it. Maybe finding the right balance between different techniques.
And it's not just their original content filling the venue, right? Concerts are picking up too.
Big time. They expect over 100 concerts this year. That's up from about 70 in 2024. And management actually firmed this as creating deliberate contention for screen time.
Contention, meaning they have more potential bookings than available slots.
Exactly. And that allows them to be selective, to prioritize the highest profit events. If Wizard of Oz makes more money per night than a typical concert or a corporate rental,
then the Tin Man gets priority.
Precisely. It's a strategy to maximize the venue's profitability by making sure the most valuable content gets the prime slots.
Smart. Okay, now the really big picture stuff. Global expansion. Abu Dhabi is still in the works.
Yes, they said pre-construction agreements there are being finalized. But the really significant update, the one that got a lot of attention, was the formal unveiling of the small-scale sphere concept.
Ah, the mini-me sphere.
Basically. This could be huge for the scalability argument. They've completed the design, they've worked out the business model, key points. They'll be much less expensive to build.
Compared to the Vegas one, I'd hope so.
Right. Multi-billions is a high bar. And much faster, they're targeting just over 2 years from breaking ground to opening one of these smaller works.
Few years. That's quick. And the business model is different.
Critically different. They're aiming for a capital-light franchise approach. That's the key phrase. Instead of SPE funding and building these things themselves.
They license the design, the tech, the content to partners.
That's the core idea. They didn't completely rule out maybe putting in a tiny bit of seed money, like a small stub investment, just to help get the first few partners going. But the main strategy is franchising.
That completely changes the risk profile, doesn't it? Shifts it from construction debt onto finding reliable global partners.
Absolutely. And the content model is designed for this. They stress that the content, like Postcard from Earth, is evergreen. It can play in these smaller spheres. It can play in Abu Dhabi 10 years from now. They create it once, monetize it across the whole network.
Okay, that capital light pitch is interesting. Is the market buying it yet, though? Or is there still skepticism about whether they'll really stay hands-off on funding future builds?
Definitely skepticism, which explains why the stock gave back those initial gains. The proof, as they say, will be in the pudding. How does that Abu Dhabi deal actually get structured? What does the first small sphere partnership look like financially? If they truly manage to keep major construction risk off their own balance sheet, then yeah, the economics look way more attractive.
And quickly, any update on MSG Networks beyond the restructuring? Still looking at deals.
Yep. Management confirmed they're still considering strategic transactions. They mentioned believing the RSN market needs consolidation, fewer players offering bigger, more centralized sports packages. So they're open to being part of that, it seems.
Okay, so if we zoom back out and connect the dots, this quarter's market reaction, that pop and then the drop, it really tells the story, doesn't it?
It's a perfect case study. The initial huge rally was purely on that GAAP EPS number, the paper profit. But once investors dug in, maybe listened to the call, they realized it was driven by that non-recurring debt gain.
Right.
And so the stock settled back down, reflecting the reality that while the actual operations, the venue utilization, the cost control, that stuff is looking better.
Constructively bullish, as analysts might say.
Yeah, exactly. Right. But the headline beat wasn't sustainable profit growth.
So the core debate, the lingering skepticism, it's still about whether this whole thing can be consistently profitable long term. And can they really pull off this global expansion without breaking the bank again?
That's precisely it. People are watching the economics of Wizard of Oz. Does that higher price point stick? Can they keep filling the venue? And crucially, can they actually finance and get permits for more spheres, especially big ones, at a scale that makes sense? Plus, this whole capital-light franchise model needs to be proven out.
Makes sense. So, near-term things to watch.
Definitely updates on Abu Dhabi. Any concrete timeline news there would be key. The actual box office and reviews for Wizard of Oz once it opens. And just the general pace of bookings, corporate events, new residencies heading into the fall and winter.
Got it. Okay, that sets the stage perfectly for our favorite segment. This is not financial advice. A purely hypothetical brainstorm, folks, just for fun and education.
Absolutely not a recommendation to do anything. But given everything we've just discussed, especially that strategic pivot towards the capital-light franchise model for the small spheres, the whole risk equation changes, doesn't it?
Yeah, it feels like the main risk isn't so much can they afford to build another multi-billion-dollar venue anymore. It's more about can they successfully scale the content globally and make this franchise model work.
Right. The risk shifts from balance sheet construction debt to IP monetization and global execution.
Okay, so here's the outrageous but plausible pitch, framed like we're talking to a hedge fund manager. How about a pair trade?
Ooh, I like it. Go on.
We go long the sphere segment, specifically betting on the success of that IP licensing and content creation engine. You're essentially buying into the global small sphere franchise dream and the value of that evergreen content library.
Okay. Long the future vision, the content IP. What's the other side of the pair?
We short the potential value realization from MSG Networks, meaning we bet against their ability to get a really great price or favorable terms in any potential RSN consolidation deal.
So you think they will eventually do a deal, but maybe the market's overestimating what that legacy RSN asset is actually worth given the subscriber bleed.
Exactly. The rationale is SPE is trying to become this global IP franchiser. That's the exciting growth story. The RSN debt fix was necessary, but it just stabilizes a business facing fundamental headwinds. So you lean into the high upside potential of the Sphere franchise model,
while hedging against the messy reality and potentially disappointing valuation of consolidating those declining RSN assets. Interesting.
It captures the internal tension within the company right now, doesn't it?
It certainly does. Okay, let's wrap this deep dive up. What's the final takeaway from this Q2 call?
For me, it showed real operational progress at the Vegas Sphere. Demand is clearly strong. They're managing the venue better, controlling costs. That part looks good.
I agree. But that massive EPS beat, it was a really important reminder that sometimes the biggest headline numbers come from financial engineering, from capital structure changes, not purely from selling more stuff. You always have to look under the hood.
Always. So thinking longer term, what's the big question listeners should be mulling over?
Well, considering everything Dolan said about AI and content creation, the focus on IP licensing, the small sphere franchise model, it makes you wonder, what is the long-term competitive advantage, the real moat for Sphere Entertainment?
Is it the building itself, that giant, spectacular, incredibly expensive to replicate physical venue?
Or is it the content pipeline? The ability to create these unique, immersive, potentially AI-enhanced experiences that can then be distributed and franchised all over the world in big and small venues? Which asset, the physical shell or the content engine, is actually more valuable for driving future growth?
That's a great question. Is the value in the hardware or the software, essentially?
You got it. Something for you to think about. Which horse are you betting on long term?
A fascinating point to ponder. Thanks for joining us on this deep dive. We'll be back soon to unpack another set of crucial earnings.